Please stand by. Good day, and welcome to Jeffrey Gundlach's 2023 Just Markets webcast. Today's conference is being recorded. At this time, I'd like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead.
Well, thank you, and good afternoon, and welcome to the DoubleLine webcast with Jeffrey Gundlach. Title of today's webcast, Just Markets. What's going on? Want to highlight some of the upcoming thought leadership here at DoubleLine. Our fourth annual Roundtable Prime will be released in stages. The first one tomorrow, it'll be a macroeconomic state of play. Then on January 12th, a market outlook. And then on January 13th, best ideas. That fourth annual Roundtable Prime will feature some of today's financial thought leaders, Jim Bianco, Daniel DiMartino Booth, our very own Jeffrey Gundlach, Charles Payne, and David Rosenberg, and it's being moderated by our Deputy CIO, Jeffrey Sherman. And lastly, please go to doubleline.com. We have various other thought leadership areas of mediums, DoubleLine Channel 11, and our Sherman Show podcast and Monday Morning Minutes. So without further delay, I'm going to turn the webcast over to Mr. Jeffrey Gundlach.
Thank you, Ron, and thanks everyone for joining us for the 2023 Just Markets webcast live from Pacific Palisades, California. We're starting to dry out here finally after a lot of rain. I'm trying to get a slide to shift here. There it goes. On the screen now is the album cover, What's Going On, by the incomparable Marvin Gaye, the Prince of Motown, also known as the Prince of Soul. He was one of the first artists in Motown to break away from the reins of a production company. His actual last name didn't have an E at the end. He added that a little bit of an homage to Sam Cooke, who had an E at the end of his last name, Cooke, as well. His first number one single was I Heard It Through the Grapevine, which sold over 4 million copies. And he actually wanted to play football for the Detroit Lions, but they wouldn't give him a tryout. They were afraid of liability if he would ruin his music career. On June 1st, 1970, he recorded What's Going On, the lead single on the album and the album, after witnessing police brutality and anti-war rally in Berkeley. Marvin Gaye had a 4-octave vocal range with which he developed 3 distinctive vocal voices. His smooth, sweet tenor, which he started out his career with, but then he developed a growling, kind of raspy voice, and also an unreal falsetto. And What's Going On was the first single that he recorded to utilize all 3 of those vocal styles on the same song. He did it by layering a series of contrapunctual vocal lines on different tracks. In essence, it was the vocal equivalent of the ancient art of weaving. He was inducted to the Rock and Roll Hall of Fame in 1987, and in a revised 2020 version of Rolling Stone's list of the greatest albums of all time, What's Going On was listed as number 1. On April 4th, 1984, he'd been involved in an altercation between his parents, and he was shot dead in the heart by his father one day before his 45th birthday. So take a listen to the single, What's Going On. It's a really remarkable recording. So let's get going with What's Going On. I'm having trouble turning the page again. All right, someone's gonna have to do it remotely. I'm not sure what's going on exactly. Okay, let's take a look at last year, which is truly remarkable. This is a scatter chart where we take the S&P 500 return on the x-axis, and we scatter it against the Bloomberg aggregate return for every year going back to 1976. And you can see that this was the 3rd worst year for stocks since 1976, using the S&P 500 as a benchmark, and almost as bad as 2002, not as bad as 2008. But take a look at the y-axis, the Bloomberg aggregate, by far the worst bond year by many, many hundreds of basis points. And so you see that yellow diamond down there in the lower left And this was quite the narrative for most of 2022, that it was the worst 60-40 year ever. That was no longer the case. And markets actually started doing pretty well relative to the first half in the second half of the year. It's interesting, the Fed was so far behind the curve, and we're going to be looking at this in some detail. But finally, when they got into gear with their multiple 75s, the markets really kind of stabilized. In fact, since the June meeting, the S&P 500 is actually up 4% between the June meeting and the end of the year, and was quite stable, although somewhat volatile along the way during the second half of the year. The commodity market was the best performer, certainly in the first part of the year, but not surprisingly, once the Fed got aggressive, the Bloomberg Commodity Index really ran out of steam all the way back in April and went down for the second half of the year. So a very interesting year, 2022. Most people are saying they're glad to see it go. Of course, I heard the same comments for 2020 and for 2021. So hopefully 2023 will be better. Switching the page. This is more granularity on 2020 performance of asset classes. On the left, we see equities, and they're all down pretty sharply. S&P down 18, NASDAQ down 32. You've got the FTSE actually only down about 6, so that's one of the better performing sectors. And we've been relatively bullish on European equities versus US now for over 2 years. And it started to work finally. We see fixed income, lots of double digits. We see bank loans as the only one that's even close to flat, down 0.6. In the Just Market webcast a year ago, I said quite definitively that bank loans were my favorite fixed income asset class, and that turned out to work. I'll tell you now, bank loans are not my favorite fixed income asset class. In fact, they're one of my least favorite, and we'll speak to that a little bit later in the presentation. Foreign exchange, the dollar ended up 8% for the year. It was up a lot more than that at one point. But we see that the euro down against the dollar, and we see commodities were up, and West Texas Intermediate, one of the strongest out there in the commodity sector. So that's the year that was. Let's get moving forward. I've got one more exhibit, next page. And this is credit performance more granularly in 2022. There's BB bank loans were up 3%. So it was the lower rated bank loans that made the return negative, but the BB sector was actually a decent return of 3%. CLOs, which is repackaging of bank loans, up about 1.1% on AAA, and then it starts sliding pretty rapidly into the negatives, with many sectors down 10, 11, 12%, and then some of the longer duration sectors like investment grade corporates down 15 to 20%, depending upon the letter rating, and emerging market corporate right in line pretty much with investment grade corporate at down about 15%. So by far the worst year of my career in terms of benchmark returns for fixed income. In fact, I think it's the worst return in anybody's lifetime for the fixed income market. So goodbye 2022. One thing that changed a lot in 2022 was the view of the Fed, and the Fed's actions, of course, changed a lot as well. The red line is where we were at the end of 2021. And hard to imagine that just a year ago, short rates were still at 0. And even the 2-year Treasury was only about 73 basis points. The yield curve was kind of normally sloped with a sort of 2s to 10s at about 150 basis points or so. That changed a lot. Look at the blue line where we see the effects of all of that Fed tightening in response to the non-transitory inflation. And now the peak of the yield curve is basically at 3 and 6 months, and it's pretty heavily inverted from the 3-month bill to the 10-year Treasury. And we'll see some more exhibits on this as we move along. If you look at the pricing, the next slide, if you look at the pricing of, if we change the slide to the next slide, yes, there we go, thank you. The Fed funds implied rate by the yield curve, the Treasury yield curve, has really become remarkable, where we see that the bond market pricing shows that the Fed is not going to make it to 5%. They're going to make it just under 5% by May or June, and then start cutting. And that actually by the end of 2023, the Fed funds rate is predicted by the bond market to be lower than it is today, or about the same as it is today. And then by 1 year from now, at the end of January of 2024, we're looking at something like 40 basis points or so lower than where the Fed funds rate is applied to be after what's expected to be a 25 basis point hike at the February meeting. The next slide shows how different the market's view of the future of Fed funds, that's the dotted yellow line, is versus the Fed's dot plot that just came out in December, where they're expecting the Fed funds rate 1 year from December 1st to be slightly over 5% and then slightly over 4% by the end of 2024. Clearly, the bond market doesn't agree with that yellow line. My 40 plus years of experience in finance and investment markets strongly suggests and recommends that investors should look at what the market says and take that a lot more seriously than what the Fed says. Certainly that was the case starting in the first part of the first quarter and early part of the second quarter of 2022. So I've been using this slide all year, replace the Fed with the 2-year Treasury. And once again, the Fed simply followed the 2-year Treasury. This goes back about 25 years. And we can see that the red line, the Fed funds rate, follows the blue line, the 2-year Treasury. It's pretty obvious that the Fed is not in control. It's the bond market that's in control. I remain amazed at how frequently I see commentators in financial media talk about how the Fed controls the 2-year Treasury. It's obviously the other way around. Notice that when the Fed finally catches up to the 2-year back in the year 2000, once the Fed did their last hike, the 2-year started falling in yield, and the Fed stopped hiking. And we see that same pattern in 2006. The Fed caught up to the 2-year, and the 2-year started to fall, and the Fed had to follow the 2-year back on the way down. We see that again in 2018 and 2019, same exact pattern. And now we have seen the same starting to develop here, where the 2-year Treasury is now below the Fed funds rate, the high band of the Fed funds rate, or the low band of 5.25. Remember that the Fed now uses this band concept rather than the static point. So they're sort of between 4.25 and 4.5. But the 2-year Treasury at 4.24, basically at the lower bound of that Fed range. You'll notice that in the past, the Fed has stayed at about that peak funds rate for 19 weeks, I think I heard was the average. And you'll notice that the 2-year Treasury, once it peaks out with the Fed funds rate, tends to be at its local high. So I believe that the Fed will hike once again in February. I think the bond market is fairly strongly signaling, and we're going to go through economic data that is highly corroborative of the bond market message, that the Fed's not going to make it to 5%, and maybe not even higher than the February number. That wouldn't surprise me at all. We're going to notice how the economic data is encouraging the Fed to slow down or stop, just as the 2-year Treasury is, and the Fed follows the 2-year Treasury. Let's go to the next slide. This is the Federal Reserve's balance sheet. One other aspect of the Fed's life in recent years, a couple decades, is not just controlling the Fed funds rate. It has to do with doing quantitative easing apparently on as-needed basis. The first time is back in 2008, when investors were horrified that the Fed was doing quantitative easing, and it was $200 billion. That was thought to be a huge amount. But then QE2 was needed just a couple years later, and it was more than double the size, almost triple. Let's forget about Operation Twist, although that's technically a Federal Reserve balance sheet move. We look at QE3 in 2012 to 2014. It was double again, triple rather again, nearly in size of QE2. And then we had the pandemic, and once again, we're more than double. I think there's a trend here, and I would love to see a Fed that wasn't doing quantitative easing because it manipulates things. But so far, that's been one of their bullets or one of their tools. And we'll see if they can resist the temptation to do quantitative easing yet again. The fiscal responses that go along with quantitative easing have, not surprisingly, increased markedly since the 1969 recession response. And we see that the additional deficit, which is essentially using deficit spending to quick kickstart the economy, is really a percentage of GDP. This go round was over 20% of GDP. Back in 2007, it was more like 15% or so of GDP. And I expect that if they do, and this is an if, this is a qualified statement, I'm not predicting necessarily they'll do QE, but if they do QE. My suspicion is that the circumstances will be sufficiently dire, if you will, that they'll probably have to do even more. It's one of these things where you have to keep taking more doses of the medicine as you get more of an immune response to the effects. Next slide is a fact that I think is getting some attention, but not enough. Thanks to higher interest rates being engineered by the Fed, it's obvious that the government interest burden is going to accelerate higher. So the red line is trillions of dollars of interest bill for the US government. It's been moving vertically for the past 20 years, but it's getting even more vertical. I guess I shouldn't say vertical for 20 years. It's been moving sharply for 20 years, but now it's going virtually vertical. And so that here, a couple of years from now, we'll probably have about $500 billion of excess spending just from interest if we have a $1 trillion deficit, and I would take the over on that for sure. And if interest rates stay at 4%, which may not happen, those two things that are assumed in this graphic, the accumulation of them may be accurate, but I think the deficit will grow more than 1 trillion, and I think interest rates will not stay at 4%, at least in the next couple of years. They'll probably be lower. So something that's fascinating, I've been pointing this out for a long time, is the Fed's balance sheet, which grows with quantitative easing and shrinks with quantitative tightening, seems to have a very high correlation to the progress of the S&P 500. They started this balance sheet expansion pretty mightily in the aftermath of the global financial crisis. They stopped it a little while around 2015, and the stock market stopped going up in 2014 and 2015. Then the stock market started to go up a little bit in advance of quantitative easing, but it got turbocharged with the pandemic response. And now you'll notice that the shaded area is shrinking, and the stock market has been falling almost coincidentally with that balance sheet movement. So that's worth watching as sort of a fundamental input to risk asset investment decisions. Even more interesting and more highly correlated is global central bank balance sheet expansion with the FANG index, which there's no F there anymore because it's meta. There's some new name that's been given to it that I'm terribly familiar with. Let's call it the FANG Plus Index for simplicity. And we can see that the central bank's balance sheet assets on the right-hand scale is the lighter colored blue line, and it's remarkably identical to the progress of the FANG Plus Index. Now the FANGs are actually a little bit out of sync and ahead of the 5 major bank assets on the balance sheet, but the correlation is truly remarkable. And it's interesting that the FANGs anticipated the quantitative tightening fairly correctly. So this is another graphic we'll probably be looking at as we move forward into 2023. Let's go to the economy and talk about why I think the Fed is going to have a hard time getting to 5%. And frankly, I said back in around March or May of 2022 on TV, I said, I think the Fed should raise rates 200 basis points all at once. That was right after they did the 25. And I obviously didn't expect that they would do that, but in essence, that was the right move. They had to do a 50 and then 4 75s. I think maybe they would have had to raise rates as much if they'd been more anticipatory and more reactive to the message that was being sent by the 2-year. Now they've caught up. But here are a lot of talk in the last couple of years since the lockdowns about supplier delivery delays and supply chain problems. And they're completely relaxed. We can see that this is now down to one of the lower levels on this index going back 30 years. And a lot of people think that that's good. You know, goods are being moved around again. But I would also say that it would be impossible to look at this chart without having some weight given to the idea that that delays have disappeared because of lack of demand, as the demand was obviously pulled forward in 2020 and 2021. And A, people don't have the free money so much anymore, and B, they're using their credit cards a lot with revolving credit keeping going up. So we're starting to see this consumer getting much more stressed with the Fed tightening and the lack of government money. Housing affordability has obviously collapsed. We see it's ticked up very slightly in last reading, but we're at the lowest level of affordability rating since this chart begins back in 1990. And it is interesting that the affordability index is even lower than it was prior to the housing crisis of the global financial situation back in the 08-09 period. But in that period, the affordability was really bad, and there were all kinds of crazy mortgages that allowed the affordability to get that bad. This time it's more price increases and then, of course, interest rate increases. I've used slides in the past that show that the monthly payment on the median priced home in America more than doubled from the first quarter of 2020 into 2022. Housing prices are coming down now, but they still remain very elevated versus 3 years ago. So in the credit market, the area that is least default prone is the housing market and the residential mortgage market, because there's equity. The loan quality was very high in the 2010 period until 2020, and home prices have gone up. So there was 80 LTVs and lower on the mortgages that were written, and the prices have gone up. So it's absurd to think that there will be a rash of defaults, because no one is going to mail in the keys when they can simply sell the house and pocket a 20 or 30% gain. Certainly, they won't want to lose their down payment by selling the house and defaulting and having to forfeit that 20% or higher down payment. So housing is not rescuing the economy in 2023. Here's the savings rate, which skyrocketed because of the free money from the government. The first tranche was really epic, and then the second tranche was just massively big as opposed to epic. And now it's gone all the way back down to one of the lowest levels ever. In fact, the savings rate is now running at about the same levels that were there running into the global financial crisis. So it's not like that's a really pocket of wherewithal that can be identified to accelerate the economy. The next slide shows more interesting. This is the monthly change in something that's called excess savings. Not really sure what that means, excess savings rather than just savings. But I think Charles Payne was joking with Jeff Sherman about that on the Sherman Show podcast that he did right before we filmed the Roundtable Prime that's going to be airing up on, the videos will be up later this week. But we see that the consumers' change in monthly savings, household excess savings changes, were very positive when government was giving them money, and they started to peter out, and they turned negative in the later part of 2021 and have basically gotten progressively more negative until the last couple of months, where the excess savings change is $80 billion per month. So consumers don't have money. People have to buy food that is not as elevated as it was perhaps in some pockets of the food economy, but also gasoline is elevated versus 3 years ago. Again, not as much as it was at a few quarters ago, but we see all kinds of evidence of consumers having to dip into their credit card to support their basic savings on their basic spending on necessities. Whenever I hear the consumer spending numbers come out and there's cheers that go up on Wall Street because people went more aggressively into debt, the happy interpretation of that goes on financial media is, well, they feel great. They feel so great about everything that they're comfortable expanding their credit card borrowing. I think the better explanation is they're desperate. Rather than happy, they're desperate. And so higher credit card savings is not a sign of consumer strength. It's a sign of consumer stress. And that might be why we see the next slide, consumer sentiment, which is very low. Not as low as it was a few months ago. Maybe that's because interest rates have stopped going up or something. But we see consumer sentiment is one of the lower readings that you've seen going back over 40 years, going back to the 70s even. So it's just at a very low level, not plumbing new depths. So not a lot of wherewithal in this consumer's sentiment. This is one of the last men standing. The unemployment rate is on here, and the 12-month moving average of the unemployment rate, this is the U3 unemployment rate, is on here. And we've got 3 recessionary periods. One's extremely skinny because the government responded so aggressively with the lockdowns, but this goes back to the 2 big recessions prior than that as well. And you'll notice that you get the unemployment rate going, gets to a low level, and then bounces around in a small range going sideways, and then all of a sudden it definitively crosses its 12-month moving average, and then you're in a recession. So this is sort of last man standing in terms of parts of the economy. And this is what people that want to be bullish on the economy look to. They say, well, employment is still good. And they look at this phony JOLTS number, talks about all these job openings out there. But once this thing crosses its 12-month moving average, which might happen in the next few months, it would be a strong indication that we're looking at the front edge of a recession. The next slide is the LEI, the leading economic indicator, which certainly has the look of recession in it. It's down at negative 4.5 year over year. I haven't put it on this exhibit, but the 6-month number annualized is even worse at negative 7.3. So this is heading very sharply into recessionary territory. Once you've gotten this negative year over year on the LEI, there is no scenario historically that a recession was avoided. So this is a recessionary indicator. I've brought these back. I used these bands a few years ago prior to the pandemic. And what we do here is we have a shaded area that represents kind of the path that the indicator took prior to and then going into prior recessions. Is the two middle quartiles. So it's the 25th percentile to the 75th percentile of those historical experiences. And then we take the average, which is the red dotted line, and the median, which is the yellow dotted line. And we basically try to say, where are we relative to the past experiences running up into a recession? And right now, the black line, which is the current leading economic indicator, clearly shows that we are using this overlay exactly 1 month away from the recession if you use only this one indicator, which of course we don't want to do, but this is suggestive of an imminent recession based upon historical patterns prior to other recessions. The ISM PMI, same exercise here. We don't have the median, we just have the average. But again, this is looking very much like the pattern in the two middle quartiles leading into past recessions. And we can see that by this exhibit, we are maybe 2 months away from this indicator in anticipation of a recession. Here's ISM new orders leading up to recession, same exercise. This one looks like it's maybe 2 months before a recession. I don't know, there's some judgment involved in overlaying this black line within the blue band because we don't know when the recession's coming. We're in the blue band. We know by history what the date is when the recession started, but you could easily draw this black line and put it almost exactly right at the zero vertical line front end of a recession. Obviously, the yield curve is screaming recession. Thanks to the Fed's more aggressive actions in the second half of the year, the 3-month to the 10-year became inverted. Not long ago, the 10-year yielded more than 200 basis points more than the 3-month bill. But thanks to the Fed's actions of increasing interest rates and the rally that has occurred during the fourth quarter and part of the third quarter on the Treasury market, we see that we have exactly the setup that goes all the way back to the Volcker days. So we haven't seen the 3s, 10s this inverted really since the early 80s, 30 years ago. It was close back in 1999, 2000, but that was a pretty nasty recession that ensued, and it occurred in the aftermath of a very overvalued stock market. And I talked about last year in Just Markets that using historical valuations, the S&P 500 was very overvalued. I did point out vehemently, however, 1 year ago, that as overvalued as the S&P 500 was versus its own historical valuation metrics, it was actually cheap to the 10-year. I talked about this in Just Markets 1 year ago. Not anymore. Thanks to the strong increase in interest rates and widening of spreads in credit products, the bond market is much cheaper than the stock market, even after the stock market has sold off by 20% or so during 2022. So we're going to be looking at this. The bond market started 2022 very badly valued versus everything. Inflation, inflation expectations, even equities. The bond market was very rich too. Not anymore. The bond market is demonstrably cheap to the stock market. And I recommend, this will be on the replay for Just Markets, I recommend not a 60-40 portfolio, but more like a 40-60 portfolio, or even a 40-25-15 portfolio, bonds, stocks, and then other things in the 15%, and you can listen to Just Markets to hear that. So I think that bond allocations will prove to be much more rewarding this year. I think that with the stock market being cheaper, that's a positive, but the bond market is in a much different setup. 1 year ago, bonds were all above par. And when you have a bond entry point that's above 100, when you have 100 payback, you really don't have much upside, considering that parts of the bond market are significantly callable, like the corporate bond market, and certainly mortgages could be refinanced. So if interest rates fall, you don't have any price upside on a bond portfolio purchased at, say, a price of 103. But that wasn't the case ending 2022. We see bonds that were priced at 102 priced at 60 or 70 or 75. Bonds priced at those levels, purchased at those levels, can very easily appreciate back towards par. Even if you account for some defaults on a bond portfolio priced at 70, even if you just get back 84, say you assume a hefty 16% loss due to default, that's up on maturity 20% from your purchase price. And many of these bonds yield 8, 10, even 12% at those prices. So there is tremendous upside in parts in some bond market strategies, just as much upside probably as one can rationally expect from a good year in the equity market. So bonds are not rich to stocks. For the good case, they probably have similar performance, positive performance. The base case is much higher carry in terms of income flow from bonds now versus stocks. That's the reverse of 1 year ago. And of course, the downside is probably, depending upon one's risk profile, it's probably less from this entry point in bonds than the downside on equities. So the yield curve has changed a lot. Let's take another view of the yield curve, 2s, 10s. This is one that is more commonly used, I think, than 3s, 10s, 3-month bills to 10s, but same message exactly. Inverted by about 67 basis points, less inverted than it was several weeks ago. So it's starting to steepen out a little bit, but still very inverted, first any time in the past 30 years, matched only by and exceeded only by the late 70s and early 80s. So obviously a recession indicator, again, the red shaded vertical bars are recessions, and inverted yield curves have always led, if they're sustained for some period of time, certainly that's been the case now, have always led to recession in relatively short order. Let's do that same blue band thing that we did on the economic indicators. This is the blue band thing for 2s, 10s. And again, it shows here, it's drawn in a way that suggests maybe the red line, the current, maybe it's 6 months away. Oh, this is weeks. Yeah, 26 weeks away. So 6 months away from recession, but I could easily choose to draw this that it would be more like 14 months away or something like this. Again, the red line placement is somewhat arbitrary. I have my macro team does it. Now, magazine covers are always interesting. Bloomberg Businessweek tends to have a remarkably bad record of timing their magazine covers. But back a little under 3 years ago, there was the Is Inflation Dead? And it says a new era has some frightening downsides. I'm not sure what they're talking about there. I guess deflation. But then not even 2 years and a little bit later, it's back, inflation, and there it is. Very dramatically gleaming against the black background. But again, they timed this almost at the peak of inflation, I think. So more bad timing. Let's take a look at how inflation is developing, because this is obviously critical to financial markets with tremendous volatility that we've seen in the Fed, causing tremendous volatility in the Fed's behavior. What we see here is the headline CPI was in a range of around 0 to 2.5%, maybe 3% at the high for many years. This goes back to 2012. And so for that nearly 10-year period, it was range bound. Then, of course, we had the government money spending, and that obviously led to inflation. It was amazing that people didn't see it coming. So many economists were talking about transitory inflation, but went all the way up to 9.1%. And now it's been declining for the last few months on a year-over-year basis at nearly exactly the same pace as it accelerated at the tail end of the increase into 9.1 year over year. Now we see some dotted lines on here. There's the Bloomberg Economist Survey, which expects the decline to continue at about the same pace all the way into the summer of this year. And then we see the blue dotted line, which is market implied inflation expectations by CPI price fixings. And they completely agree with the economists, except they expect the pace to remain constant. And so they expect, the blue line is expecting the CPI to come down more than the economist survey. But then the funny thing about the blue line, I've talked about this in some recent webcasts, is the prediction is it's just going to go dead sideways. That's not going to happen. Everybody knows that the inflation rate is not going to stay within a 25 basis point band for a number of years. So what happens if the Fed, if these forecasts are correct, if the market in particular is correct? I think it's absurd to believe that the inflation rate would drop from 9.1 to 2% and then magically just stop there. It's almost like a law of physics. When you have a pendulum, it doesn't, when it gets to an extreme and starts going back along the arc the other way, it doesn't stop down at the middle, it goes past the middle. And I think that if, and again, this is a conditional statement, I'm not sure the Fed's going to get inflation down to 2% in 2023 or early 2024. But if they do, if they're so aggressive that they get the blue line trajectory into December of 2023, the inflation rate is going to go well below 2%. If it goes to 2 that quickly, it's going to go below 2. I would suggest that if it gets to 2% over the course of 2023, like the blue line suggests, it will probably go negative on a year-over-year basis. And this is why I believe bond yields have peaked out. I talked about this late in the third quarter. I said bond yields are going to peak, I believe, in the fourth quarter of 2022. And so far, it appears that has been the case. So that's the economist's view on inflation. Let's take a look at some good indicators that might give us insight into where inflation could be going. One is money growth, M2. M2 leads the inflation rate. So we see M2, the blue line. We see how it went straight vertical in the pandemic response, and there was a delay in the red line, the CPI going up, but it did go up with that lag. And now M2 has crashed and is at the lowest level year over year on this exhibit, which goes back more than 50 years. And so when you get money growth this low, the last time we had zero money growth was in the 90s, and we can see that the inflation rate continued to fall for a few years after the money supply bottomed. So this is suggesting something like perhaps a sub 2% inflation rate is coming our way if the Fed works that aggressively. The next is CPI and the ISM prices paid. We've got this lagged 4 months. This says exactly the same message as the M2 chart, where inflation, the red line, headline CPI has peaked. It's now at 7.1, down 200 basis points from its peaks a few months ago. But this is suggesting, using the ISM prices paid correlation, that this inflation rate would go well below 2%. So we'll see, we'll keep an eye on what happens with ISM prices paid. They really have had tremendous volatility. Export and import prices, these are my favorite inflation measures because they don't have seasonal adjustments. They don't have all kinds of replacement, hedonic adjustments and stuff. They're just prices. And look how high export prices got about a year ago, up at about 18% year over year. That presaged the surprise on the upside of the CPI. But now it's coming down and it's only at a 6 handle. And look at the import prices paid. That got up to about 13% year over year, peaked coincident nearly with the export prices. And now both are falling very rapidly, and import price paid year over year is not even up 3% now. So it is absolutely clear that inflation is coming down. Our inflation model at DoubleLine has been quite good. It did not predict the 9 handle on inflation, but it predicted an 8 handle. And we're expecting that the May print that comes out in June of this year could very well be at around 4%. So we could see inflation go down another 300 basis points in just the next 5 months or so. So it's another support to bond valuations. Used car prices certainly went up a lot. Obviously, there would need to be a payback from a year-over-year period of over a year, where the year-over-year increase was running at about 30% on average, and now it's crashed down to about 15%. So obviously, we are not going to see inflationary pressure from used car prices. How about home prices? Well, we already saw that affordability is bad, but we had a couple of years of around 20% year-over-year gains. So housing went up by more than 40% using the Case-Shiller 20-city home price metric that's on the screen now. And now it's payback time. And this is the 3-month change annualized. So we're getting this kind of high frequency look at it, and it's down about negative 12%. And I suspect we'll be living in negative territory here for some time to come. Again, that's not a reason to worry about defaults on mortgages because we have this embedded appreciation. We would need a lot bigger retrenchment than 12% for a couple of years to wipe that out. Let's talk about commodity inflation. We say that commodities really took off in response to all the government money and then peaked out in the first quarter to the second quarter of last year, and now have been falling. Commodities are not up over the last 6 months. They're not up over the last 10 months. They're actually below their 200-day moving average, which is the red dotted line. So the red dotted line is kicking in at 120. That's fully 11 percentage points higher than where the BCom index is right now. I would not broadly buy commodities until the market proves itself. It's living below its 200-day moving average, and I would want to see it go above the 200-day moving average. That may happen once the dollar starts to resume its decline again. As we'll see in a few moments, the dollar had quite the run, and that stopped the commodity increase. And the dollar should probably be falling if we head into a recession because the Fed will have to be incrementally easy. Gold has been good in non-dollar terms. It's been good lately, even in dollar terms. But we can say broadly over the past 2 years, 2.5 years even, that you haven't had much action in gold other than sideways. In other currencies, gold has done quite well. And now that the dollar is weakening, gold is back at it. It's above its 200-day moving average. I think it's a reasonable, good time to buy gold and own gold. In fact, that was one of my recommendations in the Roundtable Prime for an actual security to own was gold, which I've turned bullish on back at about 1,800 or so. We're not very far above that right now. Real yields have been quite the story. Real yields were anticipating the inflation rate going up. So real yields were very, very low. They were negative, particularly the 5-year here, because everybody knew the CPI was going to be way up there. And so it could be negative and still have an attractiveness versus nominal bonds. But the real yields have stopped going up. And that's good news for risk assets. Risk assets hate real yields going up. So I think real yields will not go up in the first part of 2023. And they may go up in the second part of 2023 in response to Fed easing. We'll have to see about that. But that's one headwind that has at least been taken away from risk assets. And we do expect that risk assets will start the year reasonably well. I think they already have. We've seen some spread tightening. Stocks have stopped declining. And so that could be one reason to be more positive on the first part of 2023 than we were on the first part of 2022, which unfortunately turned out to be the right mindset 1 year ago. Let's take a look at the stock market versus real yields. Now, real yields are inverted. So when the shaded area is going down, that means real yields are going up. And we do that because it's that direction that correlates with the S&P price earnings ratio. And notice how sensitive the price earnings ratio is to real yields. The PE ratio is the blue line, the real yield inverted is the shaded areas. And you'll notice that the stock market got a little rally in the summer of last year because real yields relaxed. Then real yields started to go up and stock market's knees buckled. And then you got a rally in the fourth quarter, thanks to real yields easing until such time as they started to head the other way. So watch real yields. The good news is I think that they will be less of a headwind, certainly, than they were 1 year ago. Let's look at the S&P 500 now. What a wild ride. Look how smooth the S&P 500 was in its ascendancy from 2016 into 2019, and then the big drop off from the scare, and then the massive free money fueled speculative blow off that led to the peak in the fourth quarter of 2021 for the NASDAQ and early 2022 for the S&P 500. And bear markets always have tradable rallies. You could certainly see that in 2022, but each rally basically petered out around the 200-day moving average, wasn't able to sustain, and now we're below the 200-day moving average. It just seems that until such time as the Fed relents on this resolution to wring out inflation, and we think to once and for all kill the notion of a Fed put, it's going to take a lower PE than what we have right now. So that's how the stock market's behaving. But under the hood of the average, there's been a tremendous rotation. We talked about this in the summer of 2020. I showed this graph in 2020 in August or so, July or August, and I said one of the greatest trades is to get out of the market cap weighted S&P and go to the equal weighted, because the market cap weighted one was being driven by ridiculous overvaluation in meme stocks and speculative stocks and the FANG plus type of stocks. And now we've seen a complete round trip, which is very often the case when you have a speculative blow off. It goes all the way back down to where the blow off began, which was really back in the first quarter of 2019. So now there's really been no relative movement for the past 4 years almost between the S&P 500 market cap weighted and equal weighted. So right now, if you were fortunate enough to put on an equal weighted trade instead of market weighted, I suspect now might be a good time to just go neutral on that concept. Same thing was the NASDAQ 100 versus the S&P 500. This and the preceding chart really tells sort of the same message, but in this case, we got to an overvaluation of the NASDAQ versus the S&P that even took out the .com speculation. So the meme stock, free money speculation of 2021 was even more egregious than the .com, and now it's gone below the old high back in 99 or 2000. That's called a throwover, and it means the end of something. So I would expect that this trend, unlike the previous slide where it looks like it's pretty much played out, this trend hasn't made it back even to 2019 levels yet. So I think there's some room for this to continue the trend that began about 2 years ago, and we talked about it at the time. Another trend that has been relentless, this slide only goes back about 5 years, 6 years, but US has been a world beater. I think everybody knows that. The S&P 500, the MSCI US has handily beaten the MSCI World, excluding the US. That's what this chart is. So when the line's going up, the US is outperforming the rest of the world. When the line's going down, the rest of the world is outperforming the US. We talked about this one back in 2020, and it kept going, thanks primarily to emerging markets. As we'll see in a few slides, the world outside of the US has had mixed results since 2020, but when you put them all together, the US continued to outperform really until the latter part of 2022. But now this trend line has been broken, and I think that this trend has reversed. And so I tremendously favor non-US equities to US equities at the roundtable prime. I recommend zero US equities and instead more like European, but especially emerging market equities, which we'll get to. Here's the S&P 500 now just versus the MSCI Europe piece. So pretty different look than the preceding slide since 2020, because Europe on just a price level, index level basis, not factoring in the currency, has outperformed the United States since August of 2020. And basically, we started buying European stocks at that time, and it didn't really work or not work versus the S&P for quite some time, about 2 years. And now it's sort of definitively working. So that's a trade that I think has significant legs, and it's not too late to make the switch. Next slide is the S&P versus emerging markets. This now looks like that NASDAQ versus the S&P, doesn't it, that we showed the throwover versus the .com situation. This is sort of the same chart where we see that emerging markets were just crushed the S&P 500 from 1994 into 1998, and then had a major correction, but then roared all the way back into 2022 and had very high valuation, very strong outperformance versus the S&P, and then crashed on a relative performance basis. So the S&P 500 crashed on a relative performance basis. And then I think I said that all backwards, but at any rate, we see the S&P outperformed by a lot into 1999 and 2000, and then gave it all back into the global financial crisis, and then came all the way back to a new high. So the S&P 500 had monumental outperformance from 2010 until 2022, outperforming by about 4.6x. And now again, we see the throwover, and we're now not as overvalued on the S&P as we were versus emerging markets back at the other time period. But this obviously has a lot of room to run. Certainly, I'd be looking for this to go back towards 2019 type of levels, and that's a pretty big move. So that's an area where I think it's reasonable. Now, one of the underpinning factors for that is my dollar view, which is finally here in real time. I talked 1 year ago that I thought the dollar would go up during much of 2022, and it did. But I said once a recession starts to show up, you're going to have a peak in the dollar and it's going to drop. And once again, we have the magazine covers, which once again have exactly the wrong message. This time it's Barron's on their quarterly fund pullout section, October 10th of 2022, almost exactly the day of the high of the dollar index. And just days earlier, 1 week earlier, there's Bloomberg Business Week again with an untimely cover, dollar, can't stop, won't stop. They should put out a cover now that says, can't stop, won't stop, but did stop. And wait for the cover about how the dollar is headed lower before I expect the dollar to actually find meaningful, strong support or get a meaningful rally going anyway. Here is the dollar long term going back 50 years. And we saw that it held its support during recent years with that double line that's on there. I think that the dollar is headed lower. And I don't think it's going back to 115. So it's down about 103 off of the high there of about recent high of about 116. And the dollar certainly looks like it's vulnerable as the Fed is going to ease, says the bond market, more than the Fed says they're going to ease. And that's going to be incrementally bad for the dollar. Also, the deficit expanding, as I've spoken about for the past few years, and the deficit is very, very high versus GDP, although lower than it was 2 years ago. It's going to go back up in the recession. It's already going back up on the interest expense and on the lack of transfers from the Fed to the Treasury Department, which had been keeping the deficit down. They're not sending money anymore because they're losing money. They don't have excess money to help paper over some of the budget deficits. So the dollar's headed lower. And here's the emerging market currency index from JP Morgan. And lo and behold, if you have good eyesight, you can see that the emerging market currency index is now above its 200-day moving average. Not by enough to make a definitive statement about it, but if we spend some time here above the 200-day moving average, it's a massive tailwind for the relative performance of emerging markets versus developed markets, equities and bonds, should this reverse. So it's been living below its 200-day moving average for the better part of a year and a half after going sideways for the year prior to that. But it looks like something might be happening here. And here is the spread of the JP Morgan Emerging Market Bond Index Global Diversified versus the dollar index. So this is the spread on EM bonds versus Treasury bonds, and we have it mapped against the dollar index. And it's pretty obvious that the spread, the red line, is highly correlated to the blue, which is the dollar index. So the emerging markets have gone from a headwind with the currency to more recently a tailwind. We've seen the spreads come in. Spreads have come in on other products too, not just emerging markets, as we'll see in a moment. But we're kind of in a no man's land on emerging market spreads now. They're obviously were very rich at 350 over. They were obviously quite cheap at 700 at 350 over. They were obviously pretty cheap, around 600 over, although not as cheap as they were in 2020. Emerging markets do not look terrible. They have a good tailwind behind them. They are not as cheap as they were just a few months ago, however. Next page is S&P and relative to emerging markets and the dollar. So this is the equity version of the bond slide that just preceded. And here we have the S&P 500 index relative performance versus the MSCI emerging, that's the blue line, Once again, we see this roller coaster ride. We saw the big overvaluation, the same slide several slides ago, and now we have an overthrow, and we can say that the US dollar is highly correlated to the relative performance. So again, a headwind has been removed from emerging market relative performance, and it may be turning into a tailwind. So I did recommend emerging market equities as the preferred equity in my Roundtable Prime commentary. Let's take a look at interest rates and the bond market as we go through our tour of the world and what's going on. Look at this wild ride on the 2-year Treasury, where the decline was breathtaking in response of the Fed taking rates to zero during the pandemic, but the increase was sharper and even more rapid. Amazingly, the Fed was so far behind the curve, and now they've caught up. And then we see the 5-year has almost exactly the same look. The 10-year is starting to look a little different. We're nowhere close to where we were in 2006 on the 10-year, whereas we almost matched it on the 2-year and the 5-year. Then you see the 30-year is still lower than it was in 2010. It looks like we're not going to take out that 2010 level. At least that's my forecast. Next page is copper gold ratio, our old friend. Gives us a starting point on where the 10-year Treasury maybe should be. This is using a 5-year or 6-year time window for analysis, and the red line is the 10-year yield, and the blue line is copper gold. You'll notice that the copper gold ratio was screaming that the 10-year Treasury was going to go higher back into the middle of 2020 and into the beginning of 2021, and now it's screaming that the 10-year should go lower. Never ignore the copper gold ratio. You can explain it away from time to time, but they end up, it's like the dog tied to the stagecoach that's going across the going across the West in the old days. You're going to end up, sometimes the dog can be ahead of the stagecoach, sometimes the dog can be behind the stagecoach, but at the end of the trip, the dog's going to be where the stagecoach is. And this is saying that the 10-year, using the 6-year time window, should be more like at 2.5 rather than around 3.5. And if we use a 10-year time window, which I did not include in the exhibits, it suggests the 10-year Treasury, wait for it, should be at 2%. So there's a tremendous potential gain in Treasury bonds at the long end, which is wonderful because it allows you to more successfully hedge out the risks when you take some of the credit risk in the bond market, which have become quite attractive relative to a year ago. So you can sleep better at night owning some of these long Treasuries, knowing that if we have a problem, a deep enough recession that causes more credit problems, causes more risk asset problems, at least you have rally room on the 10-year Treasury. It's not ridiculous to think the 30-year Treasury can go up by 30% during a severe enough recession. And that would offset losses that you might have, at least on a mark-to-market basis, in a credit portfolio, or certainly you would expect negative returns in equity portfolio under that scenario. Spreads have not really been that wild since the pandemic. We've been relatively contained. Investment grade spreads, they blew out, and then the Fed came to the rescue illegally, violating the Federal Reserve Act of 1913, which does not allow them to support corporate bonds, but they did anyway. And so the spreads did widen during 2021 and into 2022, but they never even got to 200 basis points on index basis. And now they've come in a little bit, but they're still wider than they were at their tight. So there's a better opportunity now by far than there was 18 months ago because Treasury yields are higher and spreads are wider. But we see high yield OAS spread is elevated, but nowhere near recession levels. If you want to argue against a recession, this would be one of your better arguments, that the high yield market is not really showing an inflationary spread sign at this time. So maybe this time will be the high yield market will sit one out as being a recession indicator, or maybe the high yield market is right. So if you want to be an anti-recessionist, you've still got the labor market kind of working for you, and you've got the message of the high yield market working partially on your side, but I would say that's about it. Okay, so let's take a look at another recession sign, and this is kind of showing a recession. This is the lower tier of high yield compared to the upper tier of high yield. So how much more spread do you get on the lowest tier, CCC, of high yield versus the highest tier, BB, of high yield? And kind of got up to sort of recession levels there during 2022, and it hasn't relaxed all that much. So this is predicting basically there's going to be some defaults that are going to happen in the coming couple of years at the lower tiers of high yield. And that's corroborated by a lending standard chart, which is the next chart, where there's a survey of U.S. lending bank institutions, and they say, are you tightening your lending standards or easing them? And so that's the blue line. Are you tightening your lending standards? And then we've got the 12-month forward default rate versus the timing of the lending standard survey. So the blue line is the lending standards. Obviously, they've been tightening a lot. They look kind of recessionary in terms of where they are. The yellow line is just getting started in terms of defaults, but these lines are highly correlated. And the message that's being sent from this one indicator, which one indicator is tells a message, but maybe not the full picture. But this indicator says that the high yield default rate 1 year from now would not be unusual to have a 9% default rate 1 year from now on an annualized basis. So keep that in mind. Also, bank loans. I talked about how a year ago my favorite sector was bank loans. That turned out to be the best sector. Right now, I think it's my least favorite sector. Number one, because the Fed is likely to tighten, likely to ease, even they don't know it. And also the credit quality of the B plus and lower leverage loan market has significantly deteriorated over the last 7 years. You can see that about 53% of the single B plus and lower leverage loan market, that lighter blue line, only less than 55% was in that rating category, and now it's up near 70%. So one should expect higher default rates given this lower quality makeup of the loan market. So your coupon is going to go down on these floating rate loans. That's not a positive, and defaults are going to go up. That's the exact opposite cocktail of 2022. So I would expect a different result on relative performance. What area looks good? Well, a lot of parts of the credit market, but one area that doesn't even have any credit risk is the agency mortgage market. The red shaded area, which is almost always negative, represents the refinancing aspect of mortgages and the fact that over much of this time period, interest rates kept pushing lower, and so mortgages kept getting to be refinanceable. Agency mortgages are not refinanceable now. The prices are too low. In fact, at the peak of interest rates a few months ago, fully 92% of the entire agency guaranteed mortgage market was not refinanceable, even if you assumed a 200 basis point decline in mortgage rates. You have tremendous run room because the prices are not above par. The prices on the agency mortgage market are in the 90s and into the 80s, into the mid 80s. So you don't have to worry about people refinancing. You would want them to refinance. In the agency mortgage market, you're probably not going to get defaults because of the price activity that I talked about. But if you had defaults on agency mortgages, you would throw a party because you'd be getting 100 cents on the dollar back on a portfolio of mortgages that might be down at 90. And the way the mathematics works is that shows that there is no real negative convexity. In fact, a couple of months ago, there was positive convexity in the agency mortgage market, which is unheard of. And we were wildly bullish on agency mortgages and still remain quite bullish because of the setup on price and the fact that you have about as much upside as downside with significant excess yield versus the U.S. Treasury market. Here's my last slide, and we'll be wrapping up what's going on in just markets. This is what's really cheap in the credit market. Here we're comparing, upper left panel is AAA CMBS credit securities that have default risk, but it's very low because of their top of the capital structure, compared to the broad investment grade corporate market, which is not AAA. There's almost no AAA corporates. The investment grade corporate bond market is rated sort of low single A, high triple B. So you can make the argument, plausibly, in the aftermath of the global financial crisis, that maybe the ratings on securitized products are overstated. They certainly were in 2007. So maybe you would think of AAA CMBS as being comparable to, I don't know, AA corporates. That's still higher quality than the IG corporate index, but you can say that the CMBS market, AAA, is about as cheap as it ever gets over the last 10 years versus corporates. This upper right panel does the same thing for CLOs. And I give you the same sort of caveat, give you that same caveat where, maybe you don't believe the ratings, but look at how much cheaper the CLOs are versus investment grade corporates. In the lower left, which is BBB minus CMBS versus high yield. So again, you might be suspicious of these ratings, but it's a higher rating certainly than the high yield corporate market. And look how cheap it is. It's on the cheapest in 10 years. And then look at BBB CLOs, final panel, lower right. Obviously, these securitized products are very cheap versus investment grade and high yield corporate bonds. And so that's where you really want to be in the bonds, try to take advantage of these relative value ideas that we've gone through today. So that's something with the webcast for 2023. That's what's going on. And I'm very excited about 2023 because 1 year ago, it was hopeless. Bonds were hopeless. Stocks were hopeless. The Fed was way behind the curve, and you knew that you were headed into a horror show. So it turned into a dumpster fire. And now, relative to fixed income in particular, it's absolutely exciting in the fixed income market. I haven't been able to use the word exciting relative to fixed income since 2023, nearly 10 years ago. So there's a lot of ways to risk mingle and risk hedge now within fixed income because you have upside on treasuries, you have wider spreads, and there are portfolios in fixed income that have moderate risk that yield 6 to 7%, and there are portfolios that have less risk than equities that are reasonably risk balanced that have yields approaching or even into the low double digits if you, depending upon your risk tolerance. So with that, I want to wish everybody a great 2023. I certainly hope that we have much more reassuring financial markets. I think the Fed will help out more than they know they are going to during 2023. And the Bills are the number 2 seed in the NFL. We unfortunately didn't get the number 1 seed because of the problem in Cincinnati, which fortunately has done nothing but trend higher. So to all Bills fans, I've got my fingers crossed. And everybody, thank you for support of DoubleLine, and good luck in 2023. Goodbye for now, and go Bills.